each of these presentations, we try to have a theme, and really what has emerged this quarter for us is the theme of trying to pin the tail on the next recession. It's no question that there will be a next recession, but the question is when. And that question, I think, has really driven the price volatility in the market. And we'll talk about that throughout the presentation. Now, these numbers were as of May 2nd, but what you might be surprised on is that despite today and yesterday and the last few days of market volatility, these numbers are still pretty much accurate. The S&P 500 closed today at 4146. The Dow was at 32,977, and the NASDAQ was at 1234. So a few things emerge from these numbers. One thing is that as we look at domestic equities, what we see is that there's been a flight to large, well-capitalized stocks. So the Dow Jones, the 30 largest industrials, have done the best. The S&P 500, just behind that. But the smaller cap stocks, those that have higher price earnings, more speculative growth-oriented stocks, have fared the worst year to date. And you can see that in the NASDAQ. We also see the Euro Stock Index, which I find a little surprising, has done better than the broad market, US market. The Euro Stock Index is akin to the Dow Industrials. It's the largest of the European stocks. It's only down about 8%. It's done better despite all of the, all that's happening in Europe right now. And part of that is that the valuations in the international developed markets, the European market, were already relatively lower and have just outperformed and done fairly well year to date. The Shanghai Composite is down 16%, primarily because of fears of another COVID shutdown. We can look at the S&P index if we just focus on the S&P 500 for a couple of slides here. Over the last 180 days, the S&P 500 index is down about 10%. But I think the real story with the S&P 500 has been the daily price volatility. And this is a chart from Bloomberg that just shows on a daily basis the price volatility that we've seen in the S&P 500. Swings both up and down. And of course, today was down about nearly 4% after being up 3% yesterday. So we've really felt a whipsaw in the marketplace. And that's been reflected as well in the VIX index, which we've talked about this in previous presentations. The VIX index is known as the fear index, and it's an index of price volatility. And we've seen a recent spike in that. I think that it's also very interesting, again, continuing to look at the S&P 500, that if you look at all of the sectors that are included in the S&P 500, really energy is the only sector with positive returns. Consumer staples just barely has a positive return, but other than that, every sector of the S&P 500 is down, in some cases significantly, but it's energy that really has prevailed in the current market environment. All of this is to bring us to the S&P price earnings ratio. And as we've talked about in the past, the PE ratio is a measure of the relative price or richness or cheapness of stocks. And after being sharply elevated after the pandemic broke out, we've seen that the S&P 500 PE ratio has come back down to about a 7-year average, something at around 18 times. Chris mentioned this in his quarterly newsletter. It's actually come down even more since his newsletter, but we see that the PE ratio is at about a 7-year average. The other part of the big story of the market is, of course, interest rates. And we can see a sharp spike in 10-year Treasury yields or interest rates so far this year, coming up to near 3%. And at times they've spiked up over 3% intermarket trading. So Treasury yields driven by inflation and also in anticipation of Fed action, we've seen a sharp increase in Treasury yields year to date. So let's get to our theme, which is pin the tail on the next recession. And we looked at this price volatility chart. And I think, as I said before, price volatility in the marketplace has really been driven by speculation of, is the next recession near at hand or is it further out? Yesterday, after the Fed increased interest rates by 50 basis points, reading the notes and listening to Chairman Powell, he had talked about not having a plan to have a shock and awe strategy of big interest rates, but doing it more incrementally. The market liked that. They thought that might be good, pushing out a recession even further. Today, they've had second thoughts, and of course, the market turned. But the idea is that the market really is being driven right now by speculation. When is the next recession? So today, what we do know for certain is that in the Fed's perspective, the current market environment really is characterized by two things. First, unacceptably high price growth, inflation, and second, low unemployment and accelerating wage growth. So in terms of price growth, one of the things that we've seen or seeing is consumer prices, a sharp spike in consumer prices. And in March, we saw an annualized growth rate of 8.5%. That's the steepest increase in prices going back to the 80s. And in terms of unemployment, the unemployment rate and wage growth really is growing at rates that we've not seen for decades. So we have a hot, some would say an overheated economy that's not sustainable. So that's where the Fed comes in. And for any of you that were with us for our last presentation, we talked about the Fed and the tools that they have and their objectives in influencing or managing the economy. And really, the Fed is trying, as we had talked about before, to do two things. One is to bring price stability. So the target inflation rate is at about 2%. Right now, we're running at about over 8%. So they want to bring price growth down, and they want to keep full employment. We have full employment, and some would argue such strong employment and job prospects that we're seeing wage growth really accelerating above a sustainable level right now. So as you remember, the Fed has two primary tools to achieve these two objectives of price stability and full employment. The first one is through interest rates, and primarily through manipulating short-term interest rates. And that's what we've seen with the Fed increasing the Fed funds rate yesterday by 50 basis points, prior to that by 25 basis points, is by increasing interest rates, they can begin to cool demand and make it more expensive to borrow, and therefore cool demand. And the other tool that they have available to them is through their open market operations. As we talked about last time, that really is a tool of the Fed going out and buying stocks and buying bonds in a way to support the market. And we heard yesterday that the Fed has every intention to begin to reduce their balance sheet, or to begin to sell securities and not reinvest as securities mature, which will help cool the market as well. So what the Fed is trying to do and what the market is speculating on is whether they can have what we call a soft landing. I've taken a couple of graphs from an article in the New York Times from late April, and what the Fed is trying to do is by increasing interest rates and reducing their bond buying and security buying program, is to cool the economy, but to do it in such a way that it's slow and gentle, and we have what's called a soft landing. So they're bringing down growth, which is measured by real GDP, in a way that gets us to an equilibrium or an optimal GDP growth. Today, the market is overheated. And one of two things can happen as the Fed goes to work. One is they can not raise interest rates enough, or use their bond buying and open market operations to a point where the market continues to be too hot. And that means that inflation will continue, wage growth and wage pressures will continue to affect the market. And that's not a good outcome. The other outcome is that they could raise interest rates too much and to put too much of a damper on growth in a way that leads us into a recession. And that would be the too cold path that we see here in this presentation. So again, what the Fed is trying to do is to have a soft landing, but what the market is doing is speculating. Are the Fed actions, are the forces in the economy leading to a place where perhaps the response will drive the market into recession, make it too cold, or is it a Goldilocks soft landing or something else? And you can see, as the market will show us, that the market's vacillating between these two outcomes. What we do know for sure, it's really hard for the Fed. The Fed has a really difficult job. And one of the things that we can look at is just recent mortgage rates. You know that they've spiked, they're up over 5% now. And that's driven by a couple of things. First, at this point in this chart, the Fed having raised short-term rates only 25 basis points, but talking about a program over the next year where they would raise interest rates as much as short-term interest rates to as high as 3%. So, just a little bit of Fed action, a 25 basis point increase, and some rhetoric, you can see how it can really affect markets in a dramatic way. So the Fed's tools are, they're not super precise, and it's really hard to be just right. And again, that's what's driving the market, is just speculation on, are they just right, or are they something different? But for now, the sense is among the market that the Fed will be successful. There's still confidence in the Fed, which is really important. This is a chart, again, from the New York Times in late April that just shows the anticipation, the market anticipation of expected inflation. Now, the market expects inflation to remain fairly high over the next year, but there's still confidence that over a 3-year period, we'll see moderation and a soft landing. So we should all hope for that outcome. Which brings us to the portfolios that are managed by the foundation on behalf of each of your churches. And as you know, there are 3 primary models: a conservative, a moderate, and an aggressive. And the portfolios have performed quite well and right to expectations. Now, when I say quite well, what we're trying to do is to provide a market-based return, but to do it in a way that is aligned with Methodist principles. So the principles, as Chris will tell us, of doing no harm and doing as much good as possible. And when we look at the longer term performance, 3 and 5 years in particular, you can see that the portfolios continue to perform favorably, right on top, if not just above the benchmarks. We're going to expect to see volatility in the shorter term, but that it works out, and that the value of the foundation's work really is to deliver competitive returns that empower the work of your local churches, but to do it in a way that are aligned with Methodist principles. So given the strong and performance as expected, you know, one of the things that I think is really wonderful is not only are we earning competitive returns, but the way that we earn those returns. And just a couple of slides here. The foundation has achieved competitive returns and done it in a way that has had a positive impact. It's doing good in the broader world. So for example, we can measure across a number of different dimensions, one of which is environmental impact. And the portfolio has resulted in 59% lower carbon emissions relative to the broad market indexes. And there's some statistics there. You'll see these again in the annual report that Chris will publish and distribute. As we think about social dimensions, it is a portfolio that has a stronger anti-discrimination stance and policies, companies with stronger anti-discrimination, and more exposure, nearly double corporate exposure to corporations that are focused on education development, affordable housing, financial inclusion, and health innovation. And then lastly, in terms of the dimension of corporate governance, companies that have 50% higher instances of equal pay strategy and are committed to strong diversity programs, 58% versus 48% on the index. So the portfolio, despite the market volatility, has continued, each of the portfolios have continued to deliver as anticipated and expected, and has done it in a way that has avoided doing harm, owning objectionable underlying stocks, and then optimizing the good that's possible.